Good afternoon. Welcome, welcome, welcome. This is Professor Milligan, and welcome to another Wall Street Wednesday. Today is March 31st, last day of the month, last day of the quarter, and this is episode number 43. So as usual, I would give people a few minutes to join. I come on right after the market closes. A lot of times people are doing or working on other things, so I'll just give them a chance before I start going into it. Welcome, welcome, welcome. Again, my disclosure, I'm going to talk about a lot of things today. I believe things that can put some dollars in your pocket. After I get done discussing this, like I said, if you want to do anything with it, make sure that you speak with your financial advisor, if you have one, about what we're about to do and what's going on. What's up, Mr. Davis? How are you? Welcome. I understand if you're in Los Angeles, we definitely need to get together, so we'll make that happen. All right, so again, my disclaimer. So make sure you speak to your financial advisor. These are my thoughts. These are my opinions. As you guys know, I'm a college professor and I teach this stuff, so I'm pretty good at explaining what's going on and how you can put money in your pocket. So that's what the goal is. So again, welcome to Wall Street Wednesday, and I have people joining. A lot of things to talk about, a lot of things happening in the marketplace, as well as I know for the last couple of weeks, I've been talking about the commodities market. There's some things going on there. Again, for those who are new to investing, the one thing I can say about the commodities market, thank you, Natalie. Happy Wednesday to you too. The one thing I can think about the commodities market, there's always something in the bull market, there's always something in the bear market, and there's always something making a transition from going up to going down, or going down to going up. So we have a lot of that, basically a change in trend. So we've seen that. Some of these things are really exploding in the commodities market, and I'm going to talk about it. And basically, I guess the thing I'm going to say is on some of these positions that we've talked about in the past, if you're long or short, you want to stay long or short. Some of these things are really moving. All right, I'll just give it, like I said, a few more minutes. Any questions from you guys while I'm just giving people a few minutes to chime in? I have no problem just answering a few questions before I dive into this. What's going on, Twin? How are you? Hopefully it's nice and, hopefully things have calmed down there in Florida with your spring break people. I said to a number of my students that I repeated to them not to go to Florida and not to go to Hawaii or Mexico for spring break to calm themselves down. So we'll see. All right, so I don't have any questions, so I'm just gonna jump in right now and start. First thing I want to start with, let me get my notes here. I'm waiting for one particular person to show up. He asked me to talk about the hedge fund. Hopefully I'm pronouncing this right. Archego? Archego? I don't know. But he asked me to talk about what was going on there, what that was all about. So I'm waiting for him to come on. So I'll talk about some other things. So first and foremost, let me talk about this. As I just basically said, there are several things in commodity markets that have taken off. Let me give you so I'm going to give you a couple things today. Yeah, it's crazy in Miami. Let me give you a couple things today. One is I'm going to give you my fundamentals in terms of commodities. So let me repeat this. What I mean by fundamentals, that means that I'm getting a signal that the trend's about to change, but I have not gotten confirmation yet in terms of the technicals. So these are things I think will be changing. Keep an eye on. And then I'm going to go into things that have changed that we talked about and they're running. So in terms of new things that we haven't talked about that fundamentally still look like they should be short or long. On the long side, gold. Now gold's still been drifting down, but my indicators on the fundamental side is saying that you want to be buyers of gold. Again, fundamental. Wait for it to break through its 10-day moving average, but fundamentally keep an eye on gold. On the short side, and I've had a discussion with a couple of my former students about this one. On the short side, corn. Just keep an eye on corn. Just really, really keep an eye on corn. The other one that you want to keep an eye on is lean hogs. These have not broken below their 10-day moving average. So fundamentally, they're short. The commercials are getting really short these in a big way, but they have not broken down yet. Now, this is what I'm excited about. For the last couple of weeks, been pounding the table and talking about these. So here's a couple that are really working well. The dollar. If you got long the dollar, stay long the dollar. Yes, I'm going to talk about the leverage game in, how do you pronounce that? Archego? I don't know. Is it Archegos? But I'm going to talk about it. All right, so let me finish this up real quick on the commodities. Again, if you got long, stay long the US dollar. The dollar looks really strong. It just looks really good. So if you're long the dollar, stay long the dollar. Now, on the short side, some of these have actually started to break down. Again, the ultra 10-year treasury, stay short. If you got short, stay short. It's breaking down. Wheat. If you got short wheat, stay short wheat. Wheat has broken below its 10-day moving average. Wheat is in a downward move. It looks like we've seen a reversal. Now, these other ones we mentioned last week. If you got short, cotton, coffee, sugar number 11, the Aussie dollar or the New Zealand dollar, if you got short any of those, stay short. They have basically, they've confirmed themselves. They're in a downward trend. If you got short, stay short. Let's see how long this trend can go. Again, think about it. The other side is stay long the dollar. So on the currency side, stay long the dollar, stay short the Aussie dollar and the New Zealand dollar. In terms of the commodities, if you got short, stay short cotton, coffee, and sugar number 11. If you got short wheat, stay short wheat. And if you got short the 10-year, ultra 10-year treasury, stay short. All right, that's my commodities update. Again, that's working well. The other thing I wanted to bring up real quick, we talked about this last week, was spread trading. And when that spread gets too wide, you look for it to converge. And when it gets too narrow, you look for it to diverge. And I mentioned to you that the spread between the S&P 500 and NASDAQ, the spread has gotten wider. All right. Now, there's a high correlation between the two. They typically move together. Over time, you're going to see that correlation narrow. So what I said to you was, when you see this, short the S&P, go long NASDAQ. All right. At the same time. Now, that position is not as risky as you think, because even though your short might be naked, if that starts to run, by the way, the NASDAQ eventually will run with it. So the biggest thing that could happen to you is just run out of time. Well, long story short, as you guys are starting to see, NASDAQ is actually coming up. In fact, NASDAQ is actually close. They said, as I'm looking, they said NASDAQ might be, one of these is close to new high. But anyway, S&P is going to come down, NASDAQ's going to come up, and that spread is going to converge, come together. So that's happening right now. It's a very unique trade. A lot of your sophisticated hedge fund managers like this kind of trade because it's not as risky as you think, even though you're naked. You might be naked one asset, but the correlation between the two assets that you're long is going to really nullify that weakness. I did mention long-term capital management, and that was one of the companies that actually was doing, our hedge funds was doing spread trading, and they got hammered. And the reason why they got hammered was one of the securities that they actually were long, that security actually, as we know, Russian sovereign debt. It was Russian sovereign debt. They were long that, and Russia came in one day and said they're not going to pay for it anymore. And therefore, what that did was the Russian bonds actually had no bid, so the price dropped on those. They were long those. And of course, as I mentioned, they were short the treasuries, and there was a flight to quality. So the Russian bond that they were predicting going long, that they were expecting the price to go up, the price actually dropped. And the asset they were expecting for that value to go down, which was the treasuries, they went up. So that's how they got into trouble. Now, all that to say leads us to that we're looking at probably when, again, I'm going to try and pronounce this, Archegos is probably right now the biggest debacle in equities since long-term capital management. So let me go into a couple of details. Archegos, run by Bill Hwang. Again, I do apologize if I'm pronouncing these names wrong. I do not look to offend, but you'll understand. He ran a hedge fund. This hedge fund, well, let me back up. Most hedge funds, 99.9% of hedge funds, have what we call a prime brokerage account. A prime brokerage account is where you have this one account. You might have accounts at all the different firms on Wall Street, but your prime brokerage account is the one that pays for everything and the one that receives the securities. So let me say it again. A prime brokerage account. The hedge funds put their capital into the prime brokerage account. When they buy securities, the securities are shipped to the prime brokerage account. The prime brokerage account will pay for them. When they sell securities, the prime brokerage account will deliver the securities and collect the cash. Everything comes to this central location. And the reason why most hedge funds have this is because they have multiple accounts on the street, and this prime brokerage account helps them maintain that. All right. Now, the other benefit to a prime brokerage account is indirectly, you're going to get leverage. And the reason why you get leverage is you're literally buying stock in one account of one firm, you're selling stock at another firm. They're all going to net at the prime brokerage account, but you literally might be trading that same capital 3 or 4 times during the day. All right, and so there's a lot of leverage in the prime brokerage account. That's why a lot of the hedge funds like them. Now, what's happened here is, and by the way, for the Wall Street, historically, prime brokerage accounts are the least, or have the least amount of risk and some of the highest profit margins for them. Goldman Sachs is probably one of the top firms when it comes to prime brokerage accounts. And again, it's very profitable. All the brokerage firms do it. All the banks do it. All right, so here's what's going on. Well, let me give you another definition too. What's going on, Richard? So we're in here talking about what happened with Archegos. And here's what's going on here. A swap. I'm just going to give you a general definition of a swap. A swap is when two entities exchange the benefits of their portfolio. So let me explain. Let's say I have an equity portfolio. And I showed to you like the positions I have, you like the portfolio. You have a fixed income portfolio. All right. We agreed to swap the results of the portfolio. So in other words, whatever gains my equity makes, you're going to get the benefit of that. Whatever income comes off of your bond portfolio, I'm going to get the benefit of that. So we basically swapped the benefits. Swap the payments, swap the benefits. Those are called swap accounts. So what happened with Archegos is that they had a swap, they had a total return swap. All right. An equity swap, total return swap, but basically it was a swap. And here's what they were doing. They were actually taking positions in stocks, but they were doing it through the prime brokerage account where they had basically purchased a swap agreement. So in essence, it never showed up on their balance sheet that they had these stock positions. But they received the benefits for the stock positions because they borrowed the money from the prime brokerage firms, Goldman Sachs, Morgan Stanley, a couple other international banks, but they borrowed the money from them. And then the prime brokerage firms used that money to buy stocks in a swap account where Archegos was getting the benefits from it, and the prime brokerage firms are putting up the capital. And now, don't get me wrong, like on all margin accounts, because that's what it basically was, Archegos put up some money. From what I can gather, it looks like at some point their fund had got as high as $10 billion. The challenge they had was they made investments of $50 million. Now, someplace I saw was 5 million, 10 million. Let's use the 10 billion. At $10 billion with a $50 billion account, they basically would leverage 5 to 1. So for every dollar they had in their fund, they had basically leveraged to a portfolio that had $5 in it. Give you a quick example. If that portfolio went up by $1, they were going to make $5. If that portfolio went down by $1, they were going to lose $5. That's what the leverage they were looking at. Now, if you go 5 billion to 50 billion, it was 10 to 1. All right, so you understand the leverage. So what happened was they had 5 or 6 quality blue chip companies that they had invested in. They were looking to make the money, quality companies. They felt they were going to do really well. Well, over the last couple of weeks, as you know, a lot of the tech companies have taken a hit. They've come down. So what happened was Archegos, I hope I'm pronouncing that right, got a margin call. Again, they were entitled to the benefits, but they had to put in more money. As these equities came down, as you guys know, as the value of the portfolio dropped, the loan stayed as high as it was. They required them to put more money into the account. Now, they didn't have the cash. And because they didn't have the cash, they ignored the margin call for 2 or 3 days. After they ignored the margin call for 2 or 3 days, Goldman Sachs, I believe it was Goldman Sachs and another U.S. investment banking firm. I can't remember which one it was, so bear with me. I did write some notes, but I just didn't write that. Goldman Sachs, another U.S. brokerage firm, actually jumped in and brought the stock back. They closed out the short position. Now, let me explain again. When you get a margin call, you're expected to bring your account back up to 50% equity. If you do not meet that margin call, brokerage firms, by law, can go in and liquidate your positions. Goldman Sachs, another Wall Street firm, went in and liquidated their positions. Now, Goldman and the other firm did not lose any money, but Nomura Securities, a couple other banks, were still long these securities and the swap account for Archegos. Long story short, when the dust finally settles, it looks like that these firms could have lost as much as $6 to $7 billion off of these trades. Now, these swap contracts are unregulated. These swap contracts trade over the counter market, and they typically trade between the institutional investors. Hedge funds and other institutional investors will trade these swap accounts. So it's one of the areas that the SEC really started taking a hard look at in 2008, 2009 when the market imploded from that. Long story short, here's our next debacle. Right now it's going on. They have not yet cleaned all this up to figure out where everything's going, how big it is, how much, but the numbers can be quite staggering. And again, the reason why I bring this up is it's the margin. So make sure you understand this. A lot of hedge fund managers are no better than you are. They're not better stock pickers, all right? They're buying, in other words, I'm going to pick a stock. When Facebook was running, we all owned Facebook. When Amazon was running, we all knew how to buy Amazon. We all knew how to pick the winners. The difference between the hedge fund and us, per se, is that most you might get 2-to-1 leverage. You put up $1, you can buy $2 worth of stock. These hedge funds are getting 5-to-1, 10-to-1. In some cases, it might be as high as 20-to-1. They're getting that type of leverage. Now, the challenge is with that type of leverage, when things are going well, you're going to make a ton of money. If you're leveraged 10-to-1, what I mean leveraged, you put in $1, you borrow $10. That's leverage, all right? So when you have that type of leverage, again, I'm going to say it. If you're leveraged 10-to-1, a 1-point move in your portfolio is $10 returned to you. A 1-point down move is a $10 loss. So a lot of these hedge funds, when they become heavy levered like they are, all right, what happens is that's how they're making their returns. All right, again, they're not better stock pickers than you. In some cases, they're probably a lot worse than what you'd expect. But what they've learned is they've learned how to use leverage, and they've also learned how to hedge. Now, the gentleman who runs that Archegos fund, the one that we've all been reading about, Bill Hwang, Anyway, he was suspended from the brokerage industry for insider trading several years ago. So he is what we call I guess the word is, an aggressive risk taker who's willing to take shots to try and make the big returns. And it was a family trust, a family fund. All right, I broke that down. Hopefully you got it. I can answer more questions on it if you want. But again, that's what you're looking at. And the reason why the SEC is going to step in on this and they're going to take a hard look at this is because there was no transparency. That's a big one. I forgot to mention that. By the prime brokerage firms buying these securities and then selling the swap to this hedge fund, they could not tell what stocks the hedge fund owned and what size. As you guys know, if you take a position in a company that's bigger than 5% of the shares outstanding in the float, you have to file with the SEC and tell them what your intentions are and that you have ownership in it. Again, it's another way of bringing transparency into these transactions. Well, in this case, there was no transparency. They had no idea how big this fund was. They had no idea what they were invested in. And that's what the risk is. What's up there, Booby? Boo, how are you, sir? All right. I'm going to leave that now. I think everyone got it. I'm going to leave it. One of the things I did want to bring up, let me see if I can find it now. Of course, that's not it. Let me wave there. And of course, oh, no, there it is. I apologize. I found it. I found what I'm looking for. There it is. All right. And so this is what I was just talking about. This is the story. You can see it. The debacle on Wall Street. Again, this one's as big as long-term capital management. And just a reminder to you, long-term capital management almost took out the U.S. Treasury. So that's what you're looking at there. All right, let me give you this also. All right, come back to me. I said come back to me. All right. Now, the other thing I want to talk about, and I'll put up real quick, is I'm back to my PRCSM criteria. I told you I was going to go through each one of these a little bit each week, and today we were covering C for capital. Again, just a quick reminder, PRCSM is the acronym for the 6 criteria I look at for my investments. I mean, the best way to put it is, even if you're a short-term trader, it's easier to trade a stock that's going higher in an upward trend and trading extremely well than to trade a stock going sideways or a stock going down. So one of the things that I've done over the years is I've looked to find what I call the best companies at the best price and buy the best quality companies. These are 6 criteria over time that I developed in my mind that I use to help me find these stocks. All right, that's PRCSM. Now, today we're talking about capital. And let me get out of this. I'm trying to get out of this. I got out of it. Okay, cool. Today we're talking about capital and our PRCSM model. Again, just go through it. P stands for product or service, disruptive, innovative. Can you build an industry around it? The R stands for reward to risk. In other words, if I'm going to jump onto this stock and buy it, what kind of returns can I look for? As I mentioned to you in the past, and I'm mentioning it again, I do not buy a stock looking for a 5-10% return. That's not what the goal is. If that's what your goal is, to make 5 or 10% return on your money, my advice to you is to take out an ETF or S&P index fund, buy that, throw it in the drawer, and forget about it. All right. The C stands for capital. That's what we're on today, capital. What is the company doing with the capital it generates? It's excess capital. What's the company doing when it raises capital? Where's that money going? What are they using that capital for? It's really key. What are they using the capital for? All right, we're going to talk about that. S stands for scalability. Can you scale? Can the company scale? Can the company go from having 10 customers, 100 customers to 1,000 to 10,000 customers? Can the company scale? And in scaling, can they reduce their costs or maintain their costs and increase their profit margins? Is the company scalable? And don't get me wrong. I'll give you a prime example. Is it Amazon or Google? Get myself right here. Google. No, Amazon. Amazon is not scalable. All right. Amazon, if you look at Amazon's costs are rising just as fast as its revenue. It's not scalable. Doesn't mean you can't make money. Tesla, not a scalable company. All that money is being spent to actually build these factories. That's not scalable. But doesn't mean that you can't make money. The last 2 are M&M, management and markets. Management. Who's the jockey riding these horses? Wall Street bets on jockeys, not on horses. Who are the jockeys that are steering this horse, running this horse, riding this horse? That's what we want to look at. Who's running it? Who's management? What's their skill? What's their skill set? What's their knowledge? What's their area of expertise? And then last is market. Tie market to product. Is this disruptive, innovative product? Is it so big it can actually create its own market? Case in point, Amazon created a whole new market. all right? Online retail. They might not have been the first, but basically they're the innovators. They're the ones. So again, is there a market for this product? How big is that market? Does that market have enough potential to make this into a Fortune 500 company? That's the thing that we're looking at. That's my criteria. Now I'm going to talk about capital. So again, let's go back. The company started out, it's young, it's new. Where do you find out what it's going to do with the capital it raises? The first place you want to look for publicly traded companies that have just gone public is the prospectus. In the prospectus, a section called proceeds. And what that is the corporation's intentions on what they plan on doing with the proceeds they receive from doing this offering, whether it be an IPO, a secondary offering, a seasoned offering, or be a bond offering. What do they plan on doing with these proceeds? What are they doing with it? All right, we want to look. I'm not saying that you have to analyze each dollar of the proceeds. What I'm saying to you is, what are they doing with the money? Are they out there, reducing debt, changing their capital structure, and R&D? Are they developing or improving their product? All right, we want to see what they're doing with the capital. Or is the capital basically being raised to basically bail out or cash out some investors? Once the company's publicly traded, other places we can go to find out what they're doing with the capital. A quick look at their 10K, which is their annual report, or their 10Q. You want to scan it. Again, what are they doing with the money? Now, in Tesla's case, not scalable, but what they're doing with the money, it's easy. We're building a new factory so we can actually produce more cars to sell more cars. We can't meet demand. Revenue's growing at a substantial number, double-digit, high growth, but we could actually grow faster, but we can't meet demand because we need to actually build more factories. All right, use of capital. As you saw, we talked about, maybe we didn't talk about, Apple has decided to start making its own chips, semiconductor chips. So Apple's made a major investment into this plant and property to actually be able to manufacture their own chips. They're not going to outsource anymore. They're going to manufacture themselves. That's a use of capital. The last place that we'll look for use of capital is in the statement of cash flow under the section of finance activities. Corporations that have extra cash, all right, they're stewards. What are they doing with that? That's where you can also find out. Are they paying out dividends? We can see if they're paying dividends. Are they buying back stock? A number of these corporations have been buying back stock. These tech companies were buying back stock when they were running and setting new highs. Excuse me. Are they buying back stock? Are they retiring debt? What are they doing with this excess capital? Are they putting it back into the business? Are they acquiring other companies? Now, you guys know that Amazon, Google, Apple, Facebook, Microsoft, IBM, not only do they take that money, that the excess cash they get, but they're taking that excess capital and they're buying more companies to expand into their business and their markets. So what's going on with a lot of these tech companies now, rather than try and develop that technology themselves, they're scouring, looking around for these startups, these new businesses, these private equity companies, these startups. They're looking at those, and rather than waiting for them to go public, a lot of times they're buying them before they can reach to the public. Case in point, I believe it was Amazon that purchased Ring for the delivery service, and they also purchased Pill. And Pill was a pharmacy company that actually, you can actually get your medicine delivered through them. They purchased them to expand their business, to expand their hold in terms of their delivery service and their products that they offer. What is the company using the capital for? You want them to be good stewards with the money. You don't want to see them having that cash just sit on the sidelines, have a large amount of money sitting in their current assets, not doing anything. You want to see what they're doing with this money to continue to help this company and this business grow. All right. Let me say this to you. What's up, Shauna? How you doing? All right. So that's what I want to talk about. Again, just a quick reminder. We talked about commodities. We talked about what's happening with the hedge funds. By the way, when these brokerage firms started to liquidate the position on the hedge funds, understand this: they're not trying to sell it at the best price. Their goal is to get out of this as quick as possible. And Goldman Sachs and the other brokerage firm that got out of this hedge fund, Archegos positions, when they sold out those positions on the margin call, they didn't lose money. They got out fast and quick. The other ones that were sitting around not sure what to do, they're the ones that got hurt. Now, when this whole thing with the prime brokerage firms came up, they interviewed Warren Buffett in 2002. And this is, again, before 2008, before now. And Warren Buffett basically said that he thought that this was going to be one of the biggest mistakes Wall Street ever made, was this type of swap that they were putting out there. And he saw no upside but unlimited risk. And part of this came from, as you guys know, the fact that the banks now can do brokerage business. That also did not help. So it put a lot of these banks at risk trying to make money. All right. So with that, again, we talked about the commodities, what we like. We talked about what's going on with the hedge fund and how literally this could be the biggest equity debacle since 1998 with long-term capital management. And then we talked about our pricer model. With all that said, I've covered everything I wanted to cover. So again, if any of these things I'm talking about, you need to have further discussion with your broker, your brokerage firm, if you plan on doing anything or any trades on it. Now I'm going to open up for questions. I'm also going to open up if you have any stocks you want me to look at or anything you want me to ask. Now's the time, and I'll feel free to answer any question that you might have. So I'm going to I got my charts up, and I'll give you guys a chance to type in what you're looking at. Let's see. If those brokerage firms offloaded tons of block shares knowing that there's no fundamental changes in these blue chip companies, wouldn't they just push into someone who would get it for a discount? Two things. That's a great question, by the way, Lance. Two things. One is there's a time factor in this. All right, they had actually put a margin call out for 3 days. And if you guys know, I believe it's T+2. By the third day, if you have not against you, the brokerage firm is going to buy you in. That's the first thing. The second thing is these stocks were in a downward trend. They weren't moving higher. So when they came to drop them on the blocks, I imagine that when they dropped these blocks on it, that the traders who were interested in this backed off, in these stocks, backed off knowing that. And by the way, this was not a secret on Wall Street that this hedge fund had a margin call. So I believe that a lot of institutions were saying, I'm going to back off and wait. And the reason why I would wait is not only would you have the selling, great question, Twin. Not only did you have the selling from these two brokerage firms, but you had several other banks that still had not liquidated their positions, which means that you're probably going to see more selling pressure come in. And all those stocks, as these brokerage firms started to unwind those positions, all those stocks came in. If anything, and you had a good idea what was going on, those were perfect shorts. Those were perfect shorts. At some point, Lance, I do agree with you that these will bottom out when that selling pressure is gone, and you'll see them bounce and probably go back up. But the other side of the coin, too, is that the tech sector right now is under weakness. Now, I'm getting some questions on EPAM. I am still long EPAM. Why? Because my cost basis was so low. So I'm going to look at, hold on a second, let me look at the chart again. I don't see any reason why to sell this. I think the stock will continue to rise. I think the fact that it fought through with all that's going on in the tech sector, this thing actually took a hit, came down, fought through, and now it's back up to its old highs. I guess the thing I would say to you is this, Twin. You took the worst part of the ride. And what I mean by that is you've been long the stock, you saw it come back down, and you stayed with it. Now that the ride is starting to smooth out and get back to maybe where it was, don't jump. The thing I'm going to say to you guys is, which I always say, we don't sell up stock. All right? If you're going to sell this, you sell down stock. You don't sell up stock. So EPAM has actually moved back. It's moving back in the favor. It's basically, the old high was 400 and change. Hold on a second. I'm going to tell you exactly what the old high was. The old high was, looks like 402. And then today the stock went as high as 407. closed, pulled back, and it went off a double the average daily volume, almost twice the average daily volume. I would not be a seller of this stock in this type of move. I would not. I would be patient with it. And again, like I said, and Twin, I don't know if you look at the charts at all, but if you do look at the charts, switch it from a daily chart to a weekly chart and take a look at that. And what you're going to find is that the stock is actually trading relatively well. I'm pulling up as we speak, and I'm trying to get all of the chart, all the stock price in the chart. This stock has had a tremendous move over its short lifetime. And so again, I'm looking at it now. Just to give you a little more numbers, and I'm going to jump on this and go to my other question. Just looking at this real quick. Right now, I'd say resistance, support's at 364, 365. Resistance is right where we're at, 400 and change. I would, based on the way it's trading, the way it's looking, I would expect it to continue its upward trend. Yeah, I'm looking at this chart. This is a beautiful chart. I call this stairway to heaven, realistically. I see no reason to sell it. It has not given you a reason to sell it. If you wrote it this long, keep riding it. All right. Omavi, how are you, sir? Long time no see. Welcome. Housing market was booming, but I heard applications for housing programs are down. Is there any stock out there that should look at directly connected to the housing industry? Wow. Shootmovies.com, I'm hearing just the opposite. I'm hearing that right now that housing applications are up because of low rates, also because of the rates. Also, there's a shortage of inventory of houses in the marketplace right now. So I'm not sure if I'd be getting short the housing market. Now, they claim that the shorting in the housing market, or short inventory, not the shorting, but the inventory, lack of inventory, is because a lot of people don't want to put their house in the market for two reasons. One, they said that they think people are worried about people with COVID coming through their house, taking a look at the property. And two is, if they do sell their property, where are people going to move to and go to next? So the inventory is low. Applications are up. Applications are all-time high. And the reason being is you're looking at rates rates that I've never seen in my lifetime. And and since I'm 21 plus, you guys know I never give my age, even though this kind of gives it away. You're seeing more applications. You're seeing more people applying. You're seeing higher numbers lower numbers in terms of mortgage rates and what people can afford. Also, right now, it looks like in Southern California, which is crazy, the average price home, and no offense to anybody, $500,000. And these are basically just average type homes. The reason why they're $500,000 is because money is so cheap. So it is a seller's market, no question about it. It's a seller's market, not a buyer's market, and there's a shortage of inventory. All right, let me see. Any other questions on anything else you want me to look at? I took a look. And by the way, the stock I was just talking about just a second ago was EPAM. Again, that's what I was just talking about. It's actually one of my core positions, my long-term hold. So I'm still long the stock. Last question: the impeding infrastructure bill. Should I be looking at these industries? Interesting conversation. So my first question to you, Twin, was, have you been watching the Financial Channel all day? Because they were talking about this all day today. The answer is, so I got to answer that question with a statement. So let me first and foremost. President Biden is supposed to sign an infrastructure bill, which is going to be huge. All right. We haven't had any infrastructure bills in a long time. We have not, there's been no building infrastructure. So with that said, and I always tell you guys, we're forward-looking. Your success is to be forward-looking. So with that said, if you were forward-looking, I know a lot of institutional investors during the campaign, during the presidential election, were moving into basic materials. All right, they were moving into sectors that would, industries and companies that would do well if Biden won, and if he put in place an infrastructure bill, these stocks were going to run. These stocks have been running for a while. So my point to you is this. One, yes, if the bill is signed, they're going to do really well. But two, the stocks might be ahead of themselves right now. The stocks right now have it priced in that he's going to sign the bill. So I guess what I'm saying to you is, if I was going to go in, I would go in gingerly. I wouldn't take a full position. And in fact, I think a pullback would be healthy for it. That's one of the reasons why the Dow and the S&P were running when NASDAQ wasn't, because we saw money flowing to those basic industries, construction, materials. We saw that, and we saw money come out of techs. All right. But again, I think that the infrastructure bill and what tech will pick up, I think that's going to lead the next bull run. I think that's going to help lead the run. Great question, by the way. Great question. Remember, guys, when it comes to this game that we're playing, and that's what it is, game that we're playing, you must be forward looking if you want to make money. Forward looking. Now, once you get in that position, the next question is, you want to keep holding it. Now, the other thing I'm going to add to forward looking is just one other thing. Remember, and I've had this discussion with a couple of people for the last couple of days. The reason why you buy a stock is probably going to be the same reason why you sell a stock. I know I'm redundant. No problem, twin. I know I'm redundant, but I got to say it again. The reason why you buy a stock is the same reason why you sell a stock. If you brought a stock because President Biden was going to sign an infrastructure bill and you believe that was going to drive infrastructure, then you brought the stock for that reason. When he signs a bill, and you'll keep an eye on infrastructure, you'll see how these companies are doing, and if they actually start fulfilling on the agreement in the infrastructure bill and they start actually developing, you're going to hold that stock. If they don't, you're going to eventually sell it. All right, but the reason why you brought it was because of infrastructure. Now, do I think there's a play in shortage of microchips, AMD and MU? Yes and no. The reason why I say that is, if these other tech companies decide to follow Apple's lead and start manufacturing their own chips, then, game is on. It's one of the reasons why Intel stock took the hit that it did. Pretty much everyone looked and said they lost that contract with Apple to supply them with chips. So, and by the way, let me look at AMD. Ooh, haven't looked at this stock in a long time. So let me go to a monthly chart. Hold on a second. Come on. Contract. I'm just trying to get the whole chart up here. All the history. Because the stock's been moving for a while. All right. All right, that's what I thought. Let me switch it to a weekly and then a daily. And I'll give you a little more color. All right, that's weekly. And then I'll see daily. Whoa. So, zoom in a little more. You're sitting right at major support at 74.75. That's major support right there. Major support on AMD at 75. It's hit this 75 number once back in September 2020. Then again November 2020. Then it hit it again in beginning of this month, beginning of March. And then we're right back down here again near the end of the month. You're at major support. So the first thing I say to you is, if this stock breaks the 75 number, your next stop is probably 58, 59. Conservatively 60 if it breaks at 70, if it breaks at 75. On the upside, you got a lot of work in front of you. Stock's going sideways. So let me put it this way. Stocks typically move, you'll laugh when I say this, to places of least resistance. All right, that's typically where they move. And it takes some type of event to break that chain. The least resistance right now is to the upside, maybe 80, 83. But if it breaks that 75, that 74, 75 number, the least amount of resistance is going to take you all the way down to $58 a share. I would be very careful with this. And again, for those of you, if you decide you want to play it, by the way, I'm looking at Micron now. I haven't looked at this stock in years. I'm looking at Micron right now. Bear with me a second. I'm looking at the chart. Micron does not have the same range, but it has the same volatility. It's actually near its high. I would, yeah. I'm just looking at it. I would, just technically looking, Micron's got a lot of volatility in it. It's trying to fight its way back up to its 10-day moving average. It's trading below that. On Micron, I'd probably, again, on both these, Micron and this, if I was a buyer, I'd wait for it to go through its old high. I'd wait through it to clear through all this congestion that it has overhead before I did anything with them. And again, on AMD, again, if it breaks 75, 74, 75, you're going to see a short. That's what I'm seeing. All right, any other questions? Fire away. If not, we can end the call early, but I'm here for you guys. If you have any questions, fire away. I'll take a look at the chart. If not, I'm going to hop. One of the stocks, this is an interesting one. I want to bring this up. Academy Sports and Outdoor, ASO. Now, I told you, there's two stories going on here with ASO. Two really interesting stories. First and foremost, the stock's at its all-time high. Oh, I take that back. Hit its all-time high back early in March, but it ran again for the last 2 days because they announced earnings. And let me type it up again. ASO. All right. I'll take a look at that in a second. At the Compass IPO. I'm not sure what that one that is. All right, so they announced earnings. Estimate was for 50 cents. They came in at $1.09. All right, they blew out the numbers, both on earnings and revenue. And that took the stock, when earnings came out, that took the stock from a low of 24 that day to a high of 27, closing at 26, almost $27. Volume was, average daily volume was 1.6. It traded 4.8 million shares that day. And then today it traded another 5 million shares. Here's what's interesting about this stock. It has one of the largest short positions out there in the marketplace. So you're looking at a stock that, one, has great earnings, two, has going higher, and three, has a huge short position. I truly expected, after these earnings came out between yesterday and today, I thought that we would see a short squeeze in this. And the reason why I thought we see a short squeeze is when you blow out the number like that and the stock typically will run, you'll get a squeeze where guys will say, let's cover, we're getting squeezed. Because they're getting that margin call. It did not happen. So I would say keep an eye on this stock, ASO, a symbol. I'm pulling up a weekly chart right now. And again, this thing has really just been trading well. So I'm just telling you right now, this stock has traded extremely well. You're at the top of a trading range. If it breaks through the top of this trading range, which it's trying to do on good volume, I would expect it. Again, this is a retail store, sporting goods store. I'm not sure that would be 3 points. You should see, at least if it breaks through this 28 number, you should see it run up to about $31, $32 a share. And that's if you get that kind of run in the stock, just keep an eye on the volume and keep an eye on the stock. I would not be surprised to see a short squeeze. This thing has come from a low of $12 a share back in September 20 to right now it's at $28 a share. Really good looking chart. If you switch it to a weekly chart, I call it Stairways to Heaven. Let's see, Lance, thoughts on Microsoft getting a $22 billion deal from the U.S. Army and for HoloLenses. I have to look at the size of the contract. I have to look at the deal. The one thing I'll say to you, Lance, right now is I'm pulling up the stock. I don't know when the deal was announced. I'm looking at the charts. Let me switch it to a weekly. And the thing I'm going to say to you right now is looking at the chart, looking at it weekly, it's a non-event. Now, I don't know if it's because of the size of the contract significant. Maybe it's the time frame. Maybe the market was already expecting this and built into it. But if that news came out recently within the last month or 2 months, it looks like in terms of the stock price, it's a non-event. The last event that really moved stock price was earnings. Yeah. Yep, the last event that moved the stock price was just ahead of earnings, and the stock moved ahead of earnings and rallied on earnings. It's not look like it's moving on this news. Sometimes, guys, sometimes you'll see these news. Oh, just came in today. So if it came in today, all right, stock had a little bounce today. Volume was up a little bit. So volume today was, normal volume is 32 million shares. You traded 42 million shares, so that's 10 million more. So you had a 33% increase in volume. And stock price virtually was up $3-4 today. It went up as much as, it was up as, let's see, low was 32, high was, so it was up as much as $7. Again, it doesn't look like it was a major factor, and it could be the fact that techs aren't doing, techs did well today. So that could be a combination of the news and techs doing well, but it looks like it's a, what was that saying? Well, it looks like it's not a major event. It looks like it's already built into the stock price. It was not anything significant enough to move the stock up or down. One of the things I'm going to say to you guys is, and Lance kind of brought this up, and that is when you, Wall Street, not just us, Wall Street is forward looking. If Wall Street got a sense that Microsoft might be getting this contract and they thought it was significant, they took a position in the stock already for that news. So one of the things, and it's kind of funny, but one of the things you'll hear say, it's an old saying on Wall Street: buy on the rumor, sell on the news. A lot of them do that: buy on the rumor, sell on the news. Now I had a question on Compass IPO. Bear with me a second. Compass, I have not looked at this IPO, but let me give you some color on this. Is this right? No, this is the composite. No, this is Compass. I'm sorry. Is this right? $3,649? Is that what I'm looking at? Am I looking at the right stock? Mavi, am I looking at the right stock? Let me know. While I wait for you to let me know, I got a couple of minutes, so let me do this real quick. Ooh, look at this. All right, the Compass I'm looking at is not an IPO. The Compass I'm looking at has been around, geez, this thing's all over the place. The Compass I'm looking at has been around for several years. Going back, so I don't think I'm looking at the right one. All right, so give me the symbol so I can look at it. Hank, what's this? Haven't really heard a lot about Airbnb opening play. Will the rise of interest rates kill it? Its valuation and drop? Hank, I love the questions you're asking me. It shows that you learned a lot in my class. I do appreciate that. I'm not sure what's going on with Airbnb. I haven't looked at it, nor the valuation on it. I'm just pulling up the stock chart right now as we speak. I'm switching to a weekly. And the first and foremost thing was I thought the company was in trouble when they did the deal. I still think the company has a lot of work to do. Yeah. Again, I don't know the fundamentals, but I'm looking at a weekly chart, and now I'm going to switch to a daily chart. And the one thing I'm going to say to you is that, shrink this up a little bit. All right, Airbnb right now is in a trading range between 178, 177, that range, to the old high of 222. It's going sideways for the last couple of months. A lot of volatility in the stock. I guess the thing I'm gonna say to you, Hank, just looking at the chart, and let me switch it to a weekly again. I would say to you is, yeah. I would say to you this. I would say that. Hold on, let me spread that out a little bit. Yeah. Bear with me a second. I'm just moving around so I can get a good look. All right. Yeah. So I'm sticking with my numbers. That 170 range, right around that, 170, support, resistance 218. It's in that trading range. I don't see, put it this way. If I was going to do anything with this stock right now, if I was a trader, I'd probably be buying, I probably would have brought it here. When it got up to that 220 range up in there, I probably would sell it and go short, looking for it to come back down to that 175 range. I would trade it that way. Yeah, it's in the trading range. It really is. If you're an aggressive trader, I would trade. Earnings came out. They beat on earnings by 19%. They still lost money, but not as much as what was expected. Yeah, just it's an interesting model right now. So I would just say to you, yeah, 175, 12, yeah. So that's what I would say. It's just moved above its 10-day moving average. It's trading sideways. It's in a sideways trend. I wouldn't be too aggressive with it in that respect. If you're a trader, buy it here, flip it out at 210, go short, looking for it to come back to 175. How long will it trade in that range? I don't know. But that's what I would do to make my money to trade it if I was trading it. If you own it, that's what I would do if that's the stock you want to trade. All right, so Compass hasn't announced yet. All right, that's what I thought. Bear with me 1 second. I can, let me go to my, as soon as I can find it. Come on, work with me. Here it is. I think I might have, I'm checking on Compass. Bear with me a second. Compass. There it is. Compass. Real estate platform. All right, there it is. Real estate platform, Compass. Margins don't look good at all. Let me see if I can also find out some more information on Compass for you. So right now, the short answer on Compass is I would not be aggressive with it at the IPO. Bear with me a second. I can actually pull up and see what's going on with the stock, even though it hasn't come public yet. Let me see if I can find out some more information for you. Yep, there it is. Hold on a second. So Compass is coming public tonight. It's a real estate firm. They're calling Compass up 25 cents to 75 cents, Goldman Sachs deal. Let me see if I can find out some more information for you. Yeah, so they're calling it up 25 cents to 75 cents on the deal. I don't see anything special about it. As I was just saying, it's a real estate company, real estate platform. So the short answer is right now, I would wait for the company to go public, and then I would wait and watch how it trades. The platform itself. So where I just had that up. Bear with me a second. There it is. Let's see, risk. I'm just kind of going through. So it's a one-stop platform, the largest real estate brokerage firm in the nation. They go public. The company intends to issue 3.6 million shares. The original price talk was $23 to $26. And did they lower the offering size? I'm about to find out though. Bear with me a second. Oh, and I got to hop, guys. I'm running out of time. All right. I just realized, look at the clock. I want to say this. All right. I apologize. Omavi, you can call me on the phone. You have my numbers. I'll talk to you guys later. Again, I appreciate you. Have a great day.